Hello friends, and good evening, everyone. Welcome back to this webinar series of Board of Internal Audit and Management Accounting. It is our endeavor to serve all of you the best, and today we are coming out with one very novel topic on early warning signals under manufacturing industry, and we have with us Apurva Mathur based at Jaipur, will be getting us through the entire story of how to actually look into that some issues arises in manufacturing industry. So even if while doing the statutory audit, if something comes in our mind, how to report it, and internal audit is an art how to actually look into those issues and come out with some solutions and report to the management. We have with us our very dear moderators, CA Kirti Jain and CA Parin Gala. So I invite one to them for taking out their time in their busy schedule and coming out coordinate and moderate these sessions. And always very active, our secretariat, CA Aarti Bansal and entire team of our internal audit board. And friends, every Wednesday we are reaching out to you, and we also want your views, your suggestions. If any of the topic, if you feel we can take up and you want to participate in this series, come forward and give your suggestions so we can take up those things for the benefit of entire fraternity, as well as this is a great corporate governance service which we are providing to the nation at large. With these words, I welcome all of you and wish you a very happy learning. Thank you very much.
Thank you, Preeti ma'am. Warm welcome to everyone. Thanking ICAI for the opportunity for considering me as a moderator and giving me an opportunity also to introduce today's speaker, CA Apurva Mathur. He is a professionally qualified FCA, FAFD, and DISA. His previous stint was with Ernst & Young in risk advisory services and a total experience of over 16 years. He has a rich experience in the field of risk advisory, internal audits, development of policies and procedures, internal controls. He has handled a large multinational companies, listed entities and SME sectors, internal audit, and also relating consulting assignments. He has been an active speaker on risk and internal controls, internal ERN and allied areas in ICAI, Internal of Internal Auditors, Institute of Internal Auditors, Institute of Cost Accountants of India, and a visiting faculty for management and communication skills at ICAI. Today, CA Apurva Mathur will take us through the early warning signals which we can get in the internal audits during the manufacturing units, which can be identified with the procedures which will be explained by him. With this brief introductions, CA Apurva Mathur sir, we welcome you and thank you for this session. Sir, the floor is yours.
Thank you so much. Very good evening to all of you. Thank you so much, Preeti ma'am, for giving a brief introduction about the topic. Thank you, Parinji, for saying nice words for me. And good evening, everyone, and welcome in the today's webinar. I will share my screen. Parinji, can I share my screen now?
Yeah, sure. Sure.
Okay. So just let me know if my screen is visible.
Yes, sir. It's visible.
Is there? Well, just a second. I'll just do some changes. Yes. Okay. So good evening, everyone. So as you all are aware that today we are going to have a session on internal audits, early warning signals in manufacturing industry. And this particular topic is very close to my heart, as being an internal auditor and being into this industry for few years now. I have been fortunate enough to visit some of the big manufacturing units in India, along with some of the SME sector also. So basically the objective of any manufacturing unit is common, be it a multinational company, be it a medium sector enterprise or be it a small sector enterprise. The challenges may remain same. The objective will definitely be the same. Now, what is going to discuss today? So today we are going to briefly touch upon the about the internal audit. We are going to touch upon the various kind of threats which are there in any industry and how we can overcome those threats. Then brief about the objectives. Then brief about the we'll be understanding the early warning signals. So basically, to understand that what are early warning signals in any enterprise. Then we will be touching upon the main processes in any manufacturing unit. So before going into deep, as an internal auditor in a manufacturing enterprise, we need to understand that what are the processes that are there in a manufacturing enterprise. Then to keep the session little practical, I have kept certain case studies, real life examples, which I have noted in past few years and which are there as a recognized threats or risk in a manufacturing enterprise. We'll be discussing those examples as well, along with the key internal controls or audit checks which we can perform. Then in the last, we will also touch upon the methodology, what as an internal auditor we can adopt to identify and to find early warning signals and to work upon those areas. So this is all that we will be touching upon in next 1.5 or 2 hours. So, and we'll be very happy to take your queries towards end of the session. So if any of you have any of the queries, I'll request that you can take down of your query, and towards the end of the session, we can take those queries one by one as well. So I'm sure that this logo or symbol we all are aware of. And so what is this logo? This is Make in India. Yes, so this is Make in India symbol. And this Make in India symbol itself denotes a lot of things. And as we all are, we all as an Indian, we can correlate with this symbol, and this gives a, a feeling of what you can say, attachment to our country. But this symbol also represents strength, manufacturing, and pride. Okay. Now, why the government of India is focusing on manufacturing sector in recent years? We need to understand that thing before we go as an internal auditor in manufacturing company. So as an internal auditor, we have a lot of responsibility to fulfill towards the management of that manufacturing enterprise. But as an overall macro level, we need to understand that what is the importance of that manufacturing sector to the country, development of India. So this sector gives not only direct employment but as well as to the indirect employment as well to a lot of workforce in India, be it IT sector, be it worker sector, be it or any kind of thing. So a lot of service industries are also dependent on the efficient functioning of manufacturing enterprises. So that is why it is very important for a manufacturing company to have the robust internal controls in place. And if the internal controls will not be in place, so definitely that kind of manufacturing enterprise will not going to survive in near future, which will ultimately lead to downfall of the whole sector if that whole sector will not prosper in longer duration. So there comes the importance of internal auditor to ensure that right checks and balances are in place or not. And again, to go into before going into depth and before going into deep for checking of any particular area, we need to identify that early warning signals about which we are going to discuss today. Now, in brief, so what is internal audit? So basically the definition of internal audit. So as you all are aware that in recent years, the internal audit, as an internal auditor, we are not only giving an assurance to the enterprise or to the management, but we are also wearing the hat of a consultant. So management nowadays, they expect that an internal auditor give them consultancy with respect to the development of the whole enterprise. So it is not only the assurance of the internal controls in place, but also suggesting way of improvements. So improvements with respect to governance of the whole company, improvements with respect to strategic risk management of that enterprise, as well as the internal control system, be it available or not available. If not available, then we have to suggest them. Then it is a regular and continuous improvement activity. It is not like that, annually we will be appointed once and we will do an internal audit and our role will be finished. This is not like that. So we as an internal auditor are associated with that company round the year. So the scope is designed such a way that some kind of process or sub process will get covered in some or the other time period during the year. Then whether the recommendations that an internal auditor is giving, whether management has accepted that, if it has been accepted, that whether the recommendation have been implemented or not. So all these things plays a critical role of an internal auditor during that engagement. Now, what are the objectives of internal audit in the manufacturing sector? Okay, so now it's very important to understand that in a manufacturing sector, so having the, identifying the areas of process improvements is the first and foremost. So we as an internal auditor need to identify that what all process improvements will be there in terms of inefficiency or bottlenecks in that whole enterprise. Maybe the SOPs are developed or not, if the SOPs are available, whether the SOPs are robust or not, whether the required policy sets are there or not, whether segregation of duties are implemented or not. So all various different things will be there. We as an auditor have to check whether the required process improvements are there on, we need to comment on the process improvements. Then all manufacturing enterprise have certain quality standards in place. Now, quality standard could be for raw material, which is incoming quality checks. Then there could be some work in progress quality checks. Then there could be some finished goods quality checks. We as an internal auditor, we need to ensure the adherence of the quality standards in that unit. Then we need to evaluate the effectiveness of the overall risk management process in the whole enterprise. So here we mean that whether the risks are being identified or not, and if they are properly identified, then proper internal controls are there in place or not. Moving over to the next slide, here we will touch upon the threats. So threats means the risk. So now we all are aware of that, what are the risks? So risk is something that which can go wrong. In a layman language, something which can go wrong in future is a risk. Now risk could be internal or external. Internal means that something which is happening because of factors within that enterprise are called internal threats. External threats are something beyond the control of that enterprise. So example could be government regulations, example could be natural calamities, example could be, say, supplier operation disruptions, or customer not meeting his deadlines, something like that. So something which is not in the control of that enterprise are external threats. Now, as an internal auditor, we need to understand that there will be various types of business risk in any enterprise. Now, what do we mean by business risk? Business risk could be related to people. Now, people are workforce, maybe staff, maybe workers. Now, any risk which is resulted from that inefficiency of worker or staff or people are people related risk. There could be breach of trust. There could be, conflicting roles given to one employee, because of which some incorrect things are happening in that enterprise. There could be over dependence on certain people. So management is over dependence on some people. That is why that set of people are taking advantage of that situation. So all these risks which are dependent on or related to the people of an organization will be called as people related risk. There could be risks which are related to process and operations. Here we mean that if the processes which are in place are robust or not. Do we have the required set of SOPs? Do we have the required set of policies in place? Whether required set of trainings have been given to people to operate that particular process? Whether process compliance are being followed by people or not? Whether required set of templates or data recording systems are in place or not? All these things collectively will fall under the area of process and operations. Then there could be some risks which are related to the finance. So this means that inappropriate financial accounting system. That means we are not doing the accounting in the right manner. Maybe not timely, maybe not accurately, or any other flaws in the accounting system. Then we may not have the correct financial reporting system in place. So all these risks which are related to the financial system in that organization will fall under the purview of financial risk. Then we have the compliance risks, which are related to the non-compliance of any statutory requirements. So this could be, say, any particular license which is required for required by a business enterprise is a compliance risk. Maybe some kind of delay in filing the compliance is a compliance risk. or non reporting to any particular government department is a compliance risk. So we as an internal auditor need to comment on the required checks and balances or internal controls in place to ensure that enterprise has the proper system to against this compliance risk. Then we have the IT security. So all the risks which are related to the IT system are called as IT risk. That means that say any antivirus is there or not in the enterprise, whether required firewall system is there or not, required backup procedures are being followed or not. So all these risks which are related to the IT are called as IT risks. Now, as we have discussed, all these 5 areas are internal. So that means that the enterprise can have the required checks and balances in place if they can have the required internal controls to fight against this risk. So these are called internal risks. So as an internal auditor, it becomes the first and foremost responsibility whenever we are stepping into an organization to identify the right risks which are prevalent in that company or enterprise. Now moving over to the today's topic. So early warning signals. So what is meant by early warning signal? Now early warning signal is, say, tip of an iceberg. Tip of an iceberg. Now you can see that an iceberg is having only a level of thing above the sea, and there are a lot of iceberg which is there below the sea. The thing that we can't see with our naked eye. And what are these? In our audit terminology, these are main observation, these are root cause or the business impact. What we as an internal auditor, whenever we go as an auditor there in the company, we can see only the tip of an iceberg, which is called as early warning signal. But when we go into deep, so we can see all these things which are there as a main observation or the root cause of that tip of an iceberg. Now, I want to touch upon the classification of internal controls as well, because before going into detail about the early warning signal, we need to understand that what are the different types of internal controls which could be there in any company. So internal controls can be 3 types. One could be preventive controls. Preventive controls is what? Like internal controls that are put in place to avoid an adverse event from occurring. That means that before happening of an event, we are stopping that event to happen. This is a preventive control. So that means that password, we are putting a password to access a computer system. Now password is a preventive control, so we can't access a system without putting a password, which is preventing me as an unauthorized person to enter into a computer. This is a preventive control. Now there could be a detective control, internal controls that raise an alert after the event has occurred. These controls are effective if detection happens before the material harm occurs. Now,
Excuse me, sir. Sorry to interrupt you. There is a request from participants to raise your voice. Like, can you adjust your mic or something?
now is it clear?
Yeah, now it is little high.
Is it okay? Okay.
Yeah, yeah.
Okay.
Thank you. Sorry.
Yeah. Okay, sorry for that interruption. I hope my voice is clear now. So I was on the part where we are discussing about the classification of internal control. So preventive control is something where the controls are put in place to avoid an adverse event from occurring. That means that the example which I have just given is, say, password policy. So as a whenever we have to access to a computer system, we need to enter a password. Whenever we need to access our bank website or internet banking, so we need to enter a password, which is a preventive control. So which is preventing an unauthorized person to entering into that system. Now, next type of controls are detective controls. Detective controls are controls that raise an alert after the event has occurred. So that is a control which is effective if detection happens before material harm occurs, which is means that something like fire alarm. So in the buildings we have fire alarm. Whenever there is a smoke occurred in a particular room or in that building, so automatically fire alarm will blow off. So every person in the building will come to know that the fire alarm there could be a fire threat in that building, so we need to get out of the building. So before that material harm occurs, the people should go out of the building so that if anything happens, so people should be safe. This is called detective control. This is also similar to we all must be doing some internet banking during late working hours, or internet banking for transferring funds for higher amount, or check clearance by the bank for a higher amount. Something we get a message from the bank, or sometimes we get a call from the bank also, or the credit card company, that at so and so time you have done this transaction for so and so amount. So that is, the bank wanted to check that whether the authorized person has done that check, the transaction or not. Because during late working hours, say 11 p.m. or 12 p.m. or 1 a.m. during night, these are the odd hours in the general thing. So any internet banking usage of a person during the odd hours will be a kind of a, early warning signal for the bank that any unwanted or unauthorized person is not doing that banking thing or not. These are called detective controls. Now, early warning signals are also some way or the other. These are kind of detective controls, where we need to identify that if a particular event has occurred, whether that event is linked to some bigger event or not. So to avoid any material harm. Third kind of controls are corrective controls, where we can say that internal controls that are designed to correct the negative impact of the unwarranted event. So this is kind of some business continuity plan is there in the company. So whenever there is a fire outbreak or any kind of virus attack in the company, so the IT people ensure that the earlier existing situation of the company will be brought back as early as possible. So these are called corrective controls. uh, Moving over to the next. So I have already touched upon certain examples in my previous slide, but here you can see that what are the different kind of examples of preventive controls. So we have segregation of duties. We have pre-audit mechanism in any company. We can have prior approval system from required approval system, authorization person in the company. We can have delegation of authorities to right set of people in the company as a preventive control. We can have dual signatories whenever there is important decision to be taken, maybe payment or maybe other say, agreement signing. We can have backup system in place to ensure that the right data is already there in the system. We can have input edit controls to, and this is an IT control wherein we can ensure that any incorrect input does not go into the system or ERP. So these are few of the examples of preventive controls. Then we can have some examples of detective controls, which means that say physical verification is kind of detective control to identify gaps in the inventory. We can have reconciliations of different two data sets to identify any anomaly between two data sets. We can have internal audits to unearth any wrongdoing or any misappropriation or inadequate practices being followed. We can have audit trail in place, so to capture the data with respect to any changes have happened. We can have balance confirmation also. Then corrective controls, insurance is one of the corrective controls. We can have root cause analysis for defects. We can root cause analysis we call as RC kappa, like root cause corrective and preventive action, which is a kind of a control to ensure that the right set of activities or acts will be done to ensure that the harm should not happen. Then IT controls such as patching or quarantining of virus, these are called IT controls. Now, moving over to the important element of understanding that what are the main processes in a manufacturing company. Now, manufacturing sector has certain set of core processes and certain set of support process. So, as an internal auditor, it's our responsibility to give equal importance to all the processes, be it a core process or a support process. Because if the support process will not function properly, it will directly impact our core process, which will lead to the production shortage or production hampering of the production continuity. What are the core processes? We have the production management, which is the core or the heart of the whole manufacturing unit, wherein the manufacturing is happening on the shop floor. We have the inventory management system in place, where we are taking the raw material, we are shifting material from one place to another. We have work in progress system. We have some warehouses in place. We have finished goods keeping system in place. Then we have the quality assurance. Now, this is also one of the backbone of the manufacturing unit, because with quality assurance, we mean that the ensuring that the right quality procedures and systems are being followed for raw material, which is incoming quality check. Right set of quality procedures are being followed for work in progress, to ensure whenever there is a shift of the production from one stage to next stage. So the right quality is being followed in that product. Then whenever the product is moved from WIP stage to finished good stage, the FG should have the required quality, should actually pass the required set of quality tests to ensure that the right quality product only reaches to the final customer. Then we have the procurement to pay function, which is actually giving a purchase order to the vendor, purchasing that product into our company, using that product, which comes under the production management. Then once the product is come, then we need to pay to that vendor to as per the defined payment policy of that company. So this is whole procurement to payment. Then we have the supply chain, wherein we ensure that the material movements take place efficiently and as per the required time set. So to ensure that whenever there is a outbound supply to our customers, so it should happen as per the given timelines. Whenever there is a one production stage to next production stage movement of goods, so the supply of that WIP movement happens efficiently. So all these sub processes comes under the supply chain process. Then we have the support process, which are very, very important, like machine maintenance. If the maintenance of a machine will not happen properly, there are high chances that machine breakdown will happen. We have environment, health and safety, EHS, to ensure that we have the right set of health and safety procedures and policies in companies to ensure that the workers don't, meet with any accident. Because whenever there is a injury to any worker, it definitely causes the production the outbreak of the production. Then we have the finance and accounts, which is ensuring that we are having the right and the correct and accurate and timely accounting of the bills which we are receiving from vendors, accounting of the material issue, accounting of the invoices sending to the customer, all these things. Then we have at number 4, we have product costing. Now, product costing means that are we deriving the cost of the product accurately or not? Are we having the required, review system in place whenever there is a change in the raw material cost or any allied cost or any indirect cost? Are we taking those changes into consideration in our product costing or not? To ensure that whenever there is a MIS or costing report submitted to management, we have the right the costing and the P&L in place. Then we have the human resource management, which is a very, very important element of any company, be it manufacturing or a service. But in a manufacturing, the manufacturing unit also needs to cater to workers. Also, there could be on-roll worker, there could be some off-roll workers as well. And as you all are aware, there are a lot of labor unions system is also there in India at different places in the country. So to ensure the continuance of the working in that manufacturing unit, the human resource department plays a very, very critical role to ensure that right sets of benefits as required by the government are passed on to the workers or not, whether the required compliances as desired under various labor laws are being complied or not, whether required set of documents and records which need to be prepared are actually prepared in that enterprise or not. So all these things come under the human resource management process. We have the scrap management. Now, scrap is something like there is a unwanted item which is generated or wastage generated once production is happening. So now scrap management is again an important area, because whenever there is a scrap sale from the enterprise is going to encash something from that scrap sale. Now, there could be instances where a good material is sent outside as a scrap to have the benefit of by that particular person who is in charge of that scrap sale procedure. So the scrap management is again a critical element in the entire manufacturing sector. Then we have statutory compliances. As you all are aware that in India we have a lot of statutory compliances, be it related to taking any license, be it related to filing any periodic returns, be it related to filing event-based compliances. So, for example, any accident is happened in a manufacturing enterprise, we need to file a certain return under the Factories Act to the concerned labor inspector. So all these statutory compliances are being followed or not. First and foremost, whether the enterprise is aware that what all statutory compliances they need to follow. If they're aware, then what are the procedures in place to ensure that the required statutory compliances are followed? And if they are followed, then do we have that system to ensure and to report to the required government authority? Then we have logistics arrangement. Now logistics again is a very gray area where the to ensure that material that we want to supply to our customers are being supplied on the required timelines as per the sales invoice. So in the logistics terminology, we call it as OTIF, on time in full, whether the material which is sent to the customer is supplied in full, which is if, and OT means on time, which is supplied as per the required deadlines agreed with the customer. Then we have receivable management, wherein we mean that when we have sold to a customer, then as per the credit terms agreed with the customer, we need to recover that amount back. So do we have the required set of policies and procedure in place to ensure that we don't have huge piled up debtors in our books? Then we have information technology, which again plays a very critical role in the today's era, because all the machines in the major manufacturing sector are automated machines. We need to have the right set of IT policies in place to ensure that the machines are operating properly. The data which is generated in the operation side is not compromised outside the organization, whether only the required set of people have the required authorizations and access to the required ERPs or accounting system, like that. So to sum up, all the sub processes that we have discussed here will ultimately impact our core processes if any of these sub processes will not operate efficiently, because say machine maintenance is not done timely, will impact our production management. Say EHS policy is not being followed or not there in the company, and accident happens to a particular worker, and labor strike happens or labor unrest happens, it will again impact our production management. Finance and accounts, if we are not say have the right finances in place, say we have not the right working capital in place, ultimately it will impact our procurement and impacting our production management. If the product costing is not right, again we are leading to a loss making situation, impacting our finance and accounts, directly impacting our procurement to payment, and thereafter impacting our production management, then and so on. So that means that any impact on a sub process will lead to the critical impact on our core process. So in today's next 1.5 hour, we will be discussing some of the early warning signals in core process as well as in the sub process as well. Now, going into detail, we will be touching upon certain examples of early warning signals. As an internal auditor, what we can do. Okay. Now, early warning signal first is related to production management. Now, production management, we mean that we have one early warning signal of sudden spike in production cost. Now, as you can see in the graph here, so there is a sudden spike in the production cost in the company. Now, this is an early warning signal. Now, early warning signal could be because of many factors. This could be, say, excess material, raw material has been consumed during that particular time. There could be instance of unrecorded production, which is ultimately leading to unrecorded sales, which is a loss of sales to that enterprise. That means that there is a situation when say production team has joined hand with some other team, say dispatch team, and they have actually produced in the company by using the raw material of that enterprise, but they have not recorded that production in the books. Ultimately, they are selling outside in the gray market without invoice, and the purchase cost of raw material, the electricity cost, power cost, manpower cost, these are actually recorded in the books of that enterprise, but the sales are not recorded, thus leading to that adequate or sudden spike in the production cost. Now, how to check that? So it is an important thing for us an internal auditor to understand that how we can identify such uh, early warning signal of sudden spike in production cost. So first of all, we need to be aware about the bill of material. So you must be aware of that. What is a bill of material? So to explain in brief, bill of material is a report or a document which comprises or which says that what all inputs are required to generate an output. Say, for example, to produce say this laptop, we need to have a screen, we need to have X number of buttons, we need to have say mouse pad. So we need to have a battery in place, we need to have a charger. So all these things sum up will call as a bill of material. So we need to understand what is the bill of material. Then we need to have the data with respect to the direct cost. So direct cost will involve, say, raw material cost, it will be manpower cost, it will be power cost, running operating cost of that machines, say some kind of consumables which are used in that machine directly. So all these costs are direct cost. Then there could be some indirect cost. There will be, say, now we need to look upon the sales trends as well. So what are the sales trends during the year or past year as well in the same time period, same months or same quarter? Then whether the production costs are going in line with that sales trends or not. So if they are going, then there is no problem. But if we have certain uneven spikes somewhere in between, so we need to see what are the root cause behind that. Then we need to have the production logbooks as well. Now, production logbook will capture the entire production history with respect to that what production order has been worked upon in the production flow. What is the material which is issued from the stores for production? What is the transfer from one stage to another of WIP? If any machine breakdown will happen, so that element will also be captured in the production logbook. If there is any wastage, excess wastage will also be captured in the production logbook. How many supervisors or workers will be working? This element can also be recorded in the production logbook. Now, to identify some kind of instances, we need to have that. We need to check whether the production logbook has the continuous recording of all the data. Any particular data set which is missing in between. Say, for example, the concerned production team has not recorded production logbook for say 2 shifts. So it is important for us to check whether during those shifts plant was in operation or not, workers arrived in the factory or not during that time, material was issued by the store or not. If everything, the answer of each such question is yes, then why production logbook was not filled during those 2 shifts? So this gives an indication that maybe production team has operated the production and the machines, but they have not recorded that FG in the production logbook to have that unrecorded production and sales. There could be, then we need to check the materials issue data as I've already explained, and we need to see the FG dispatch register calls. Now, to have this kind of situation end to end, there should be a collusion of the production people with the dispatch team. Now, dispatch team could be, say, dispatch team separately, which comes under the supply chain, and there will be some security team also, which are standing on the gate. Now, we need to see that all the records, there could be some element when the data is not recorded in the production logbook, and we have certain indicators, but there are entries of material or vehicle moving out during those shifts by the security gate register. Now, if the security has allowed some vehicle outside and they have recorded in their outbound register, then what was the production which has happened during that time? So this kind of indication we can get by reviewing all these data. Now, if we have that early morning signal there, and we have also identified that any kind of situation has occurred or may have occurred in the future, then we need to suggest internal controls to the management. Now, internal controls could be, as we have already discussed in the previous slide, it could be preventive or detective. Now, what could be preventive controls? Preventive controls, one preventive controls, which could be an automatic barcode pasting and production recording through scanning. Now, nowadays, as you all can see in the various electronic devices or various other devices that you must be using, that during the production time only, the machines are made such wherein there is a barcode sticker which automatically gets pasted on the machine without any manual intervention. And when that the product passed from the final stage, there is a scanner which is affixed on the top of that roller. So when the product passed on, that scanner automatically reads the data affixed on that barcode, and the production gets automatically captured in the ERP. So this is a say you can call this an ultimate usage of the technology to record the production. So there is no manual intervention for recording the production. We can have detective controls where we can do the input output reconciliation. We can see the MIS reports which are presented by the production team to the management of that unit. The input output reconciliation will give you an output about that as per the BOM, whether the standard material was consumed or not. If the material consumption is more than the standard consumption, then what were the root cause behind those this situation? So we need to understand that. Then we can also do a surprise production audit on floor, whether what is the process that they are following. During the surprise check, maybe at night or at odd hours, say early morning 5 a.m. or 6 a.m. So these kind of situation will happen only during odd hours when the senior management or the senior team people are not there in the unit. Then we have the strict dispatch control as well. Now strict dispatch control, we mean that the security team is completely independent of the production team or the supply chain team, that they are not reporting to any of these people. So that means that if the situation has to have in that company, they need to have a collusion between all these three departments, like production department, supply chain department, and the security department, which may not be very easy actually. If you have any query in this thing, please take a note. During the end of the session, we can have that query. Then the next one is again related to the production management. So here the early warning signal which I wanted to discuss with you all is high machine running hours in comparison to low output. This means that your machine is actually operating for the whole 8 hours during the shift, but the machine is not giving the right output when you see the data. So your supplier of the machine claims in the brochure of the machine that say on running of 8 hours of the machine will give say 100 units of output. But when we see the data trend in a quarter or in a year, we are seeing that at certain point of time or the period, the machine is giving output in that 8 hours not 100 but 80 or 60 or fluctuating in that manner. So this is an early warning signal. Now behind this there could be multiple reasons, multiple root cause. One root cause could be that machines preventive maintenance are not conducted. If the maintenance of the machine is not conducted on time, so the machine will not going to give the desired output. This is somewhat similar to the maintenance of the vehicle that the car or the bike that we do. So if we don't do the give the vehicle for a timely periodic maintenance to the work to the this our garage, then the average that the company claims, we will not get able to get that average. So it is ultimately resulting the efficiency of that the car or the bike. And we can have another root cause which is related to the manpower. Now manpower could be that required training is not given to that worker who is working on that machine, which is leading to breakage or say breakdown of that machine very frequently. And if a breakdown is happening for 5 minutes, then the restart hour of that machine will again be the restart time will be again say half an hour or 1 hour, because the machine has to switch on. Then again this will do some sample output or some sample production, and that after some time it will run into the full-fledged operation. So the machine operation training to operators is a critical element. If there are no periodic training to the operators, so it will ultimately lead to the low operating efficiency of that machine. Then what are the data that we can check to identify this early warning signal? We can review the machine logbooks, we can review the production data. So production data we need to see end to end. That means that the what is the operating hours of the machine, what is the the desired output from the machine which is claimed by the machine supplier or the OEM, what is the actual output that we have got, is there any breakdown between the machine operations. If there is a breakdown, that how many hours that breakdown was happened, and what was the preventive action that company has taken to ensure the preventive maintenance schedule is followed or not. We need to see the PPC data. PPC means that production planning and controlling. So production planning controlling means that whether the planned output during that 8 hours of shift is achieved or not. If not achieved, then what is the root cause behind that? Then we need to see the training records, that whether the required trainings to operators of the machine are given on time or not, and if they are given, that what is the result. Then once this early warning signals are identified, we need to suggest some internal controls. Now internal control, again as discussed, we can have preventive controls or we can have detective controls. Preventive controls means that say compliance with preventive maintenance schedule. Now preventive maintenance schedule has been prepared, but they are not followed on time by the maintenance staff. That may lead to some kind of situation. So we need to see whether the preventive maintenance schedule is followed or not. Then regular machine operations training to operators, that how to use that machine. If any breakdown happened, then how to regularize that. Do's and don'ts when we are working on the particular machines. So all these things will come under the training. If the training is periodically given to the workers, then this kind of situation may not happen very frequently. Then there could be a detective control like daily or weekly review of standard versus plan versus actual output and do a root cause analysis. So this means that there is a regular MIS report which is prepared. So first there is a production logbook. Based on the production logbook, we are recording the production data in some soft copy or ERP. Once the data is captured in the soft copy or ERP, then there is a weekly review of standard, which is a desired, then versus plan, which is the planned output versus actual output. And if there is a difference, then what is the reason behind that? And to check whether the required action is taken or not. So collectively, if we ensure that all these internal controls are followed, then the manufacturing unit can safeguard itself from this risk. Moving to the next one. So this is again related to the production management. Now, this is a little typical and complicated one, which I'm going to explain now. This is early warning signal in a multinational production industry where there was a automatic production was happening on the conveyor belt. Now, the early warning signal which was found out was the high rework, rejection, and overtime. Now, high rework means that FG has been produced, but there was some flaw in that FG. Some problem was there in the FG, which is resulting due to the reworking on that already declared FG. There could be rejections. That means that FG has been produced, but there are irreparable quality problem in that FG, which is leading to the rejection. So whole lot has been rejected. Then there, we identified that overtime. So basically that production could not be done during the prescribed working hours of that shift. That is why the management had to run the plant on Sundays or holidays, which is overtime. So these were early warning signals that these three problems were happening. Now, when we went into the more detail, then we found out that the ultimate reason or the root cause was frequent change in the conveyor belt speed by workers during night shift. Now, you can correlate with what I'm going to say, that there is a conveyor belt. Now, on the conveyor, there is a product which is kept, and conveyor is automatically moving. Along with that conveyor, the product is also moving. Now, the workers who are working and working there on the conveyor, they have to work when the product or the conveyor belt moves from process 1 to process 2. So there is a example, there is a time of say 30 seconds to that worker to complete his work before the conveyor or the product moves from step 1 to step 2. Now, if the worker changes the speed, that means that he changes the speed from 30 seconds to 45 seconds. So whenever he's reducing the speed, like 45 seconds, the conveyor is taking from moving from one process to second process, the worker is getting ample time to complete the product. Okay. Now, this is resulting in that when the shift gets completed, the whole shift was not able to complete the planned output, because the planning of the work production was done by the system based on the speed, based on the available working hours and the capacity of that whole machine, considering the conveyor belt and the number of workers. Now, if the speed of the conveyor belt is reduced from 30 seconds to 45 seconds, so the whole company was not able to meet the production target, which was leading to overtime. So during the time of say Monday to Saturday, the company was not able to complete the production because the workers during night shift were reducing the time, the conveyor speed. So they had to run the plant on Sundays every day, every Sunday of the week. So this overtime payment was impacting the company in its P&L, but they were not able to identify that why this problem was happening. When we went into the detail and we checked that thing, then we found out. Then were reverse situation also. In some of the cases, we found that the conveyor belt speed was increased to ensure that the product moves very fast. Like from 30 seconds, they have increased the speeds to 20 seconds. So now the product from process 1 to process 2, it moves not in 30 seconds, but it moves in 20 seconds. So which is giving less time to that worker to complete his or her work. Now you can imagine that when the product moves very fast, there is a lot of chances of the worker is not able to complete the work in the desired manner, which is leading to certain problems in the FG and again impacting our rework and rejection. So I hope that I'm able to explain this early warning signal properly. Now, how did we find out? That is important. We took some interviews, so basically to understand the process from the workers, to understand the process from supervisors, understand the problem from the floor supervisor, production supervisor, and the production in charge during various shift A, B, C. We did surprise visit to the production shop floor. Now, when you do the surprise visit to the shop floor, you will actually see that what is the process of moving of product from one process to step number process 1 to process 2, how the machine, conveyor belt speed is being changed. Then the review of rejection and rework data was important element. Then the plant operation roster, that means that whether there is a holiday in a month, whether the plant was operated during that holiday or not. So all these data becomes a critical element to check such kind of early warning signal. Now, once identified that what could be the internal control, which as an internal audit we can suggest, we can suggest the preventive control of access control over the changes in the conveyor belt, that only the authorized person can change the conveyor belt speed and not everyone or anyone can change. Then detective control is to have the weekly review of the conveyor belt speed change logs. That means that the machine or the system gives a log report of the machine conveyor belt speed changes, and there is a weekly review of the conveyor belt to ensure that there is no unauthorized changes in the conveyor belt. I hope I'm clear. So moving to the next one, this is again related to production management. So here an early warning signal is incorrect material consumption of raw material captured, leading to mismatch in standard consumption versus actual consumption of raw material. So that means that your bill of material in the enterprise is giving standard material consumption X figures, and when you compare standard consumption with actual consumption, you found out that there is a difference. That means your actual consumption may be high or may be low from the standard consumption. Now this is an early warning signal, but now when we go into detail and into more depth of this whole observation, there is a impact on the profitability reporting of the enterprise. Now there could be many reasons behind that. Many reasons could be that your material consumption was not recorded. So your BOM couldn't make your situation could be your bill of material is not updated. So in actual your material consumption is correct, but your bill of material is not giving the right picture. This could be one thing. Second thing could be, again, as we have already discussed in the previous slide, where the material consumption was not recorded at all, like production was not declared. So if production is not declared at all, so standard consumption will not be actual consumption will be there, but standard consumption will not come from the system. So again, it will impact your profitability. To identify this early warning signal, we can check the bill of material, we can check the production data, we can check the material consumption data, we can check stores material issue records. So which is giving a picture where the store is issuing material from the store to the production shop floor. So whether that material was issued based on the authorized requisitions or not. We can also check the rejection and rework data to find out such kind of cases. Then what internal control as an internal auditor we can suggest? Control over production logbooks. First, very important that the production logbook should be complete in all aspects, as we have discussed in the previous slide, where I was given an example where the production logbook was not filled for 2 shifts. Then this could be a material breach of the whole process. Then material issued by stores only on authorized requisition slip. Store should not issue material without having an authorized requisition slip in place. Then proper recording of data in production MIS report. If you find out as an auditor that your MIS report is not correct, so basically your logbooks is saying some different picture, your production data is saying some different picture, and your MIS report which is presented to management is saying some different picture. So this is a very example of incorrect data recording. Then periodic review of raw material consumption. So basically, again, standard versus actual, and whenever there is a difference, to immediately identify the root cause and take corrective action. So this is related to material consumption analysis. Moving on to the next example, this is related to production, a little step related to now job work. Now, there could be situation where the company is sending the material to job work for conducting certain job work on that material. Now, high job work payments in comparison to FG declared by the unit. Now, this could be an example where when you are doing a trend analysis of your job work cost vis-a-vis your FG declared or sales by the unit, then you are finding that at certain point of time you found out that there is a certain spike in the job work payments. So your job work costs are very high in comparison to your FG declared or sales by the unit. Now, a sudden spike could be because of certain factors or certain reasons. Now, one could be your excess payments, which is your the rate which you have paid to the job worker is not right. That means your invoice came at incorrect or higher price, and you have processed that invoice for payment. There could be mismatch in quantity reconciliation. That means that you have issued X quantity. Against that X quantity, job worker should provide you X plus 2 material, but job worker has not given X plus 2 but X plus 1 material, and he has charged for the whole thing. So again, a quantity mismatches between the job work and the company. To identify these cases, we need to see data related to job work issue and receipt data. So where we need to do a thorough reconciliation between the material which we have issued to the job worker and the material which we have received back from the job worker. We need to see the bill of material as well. Now, bill of material, as we have discussed last slide, which captures that how many inputs are required to generate 1 unit of output. If we check the job worker issue and receipt data and compare with the bill of material, then we can identify any extra material consumption by the job worker and whether the job worker has been penalized for that extra consumption or not. We need to see the job worker invoice as well. Now, job worker invoices will capture the rate, will capture the quantity. To back up the quantity, we need to have the right set of data with respect to the material issue and the work done by the job worker, and the complete backup attached with that invoice. And we also need to do that reconciliation of input output as discussed. Now, once we have identified the set of cases, we need to ensure that the right set of internal controls are in place or not. We need to see that whether job work challans are prepared correctly or not. We need to see that job work logbook are being filled properly or not. We need to see that regular reconciliation and monitoring of job work issue versus material received should be done in the company. We need to see that whether the invoice are processed as per the approved job work rates. We need to see whether the job work orders prepared in Tally or ARP, and if they are the job work orders are prepared, then whether they are properly complied or not. We also can do a periodic stock physical verification at the job worker site to ensure that what all material which is left over at the job worker site are actually as per our records or not. So I hope that by this example, I am able to clear position on the job work related payments. Now, moving on to the next one, this is related to the quality assurance. Now, quality assurance, in quality assurance, we can have a early warning signal of sudden spike in customer complaints or warranty cost. Now, for this, when we review warranty cost during a particular period in a year or say 2-year period, or customer complaint data that we capture from CRM data, then we can find out that if there are any sudden spike in a particular period, then this is an early warning signal. We need to go into detail and to more depth to find out the root cause behind that sudden spike in the customer complaint or warranty cost. And if there is a root cause which found out, then what are the internal controls that the company has implemented. Now, this is a clear case of inadequate quality checking of the products. Okay, now what data that we need to check for this thing, we need to check the warranty cost ledger from the ERP, that to identify the total cost which we have paid against that product replacement or repairing. Then we need to see the customer complaint data. We need to see the QC record, which is quality checking records. Now, quality checking, we need to see end-to-end, like raw material checking, WIP checking, and FG checking, whether the required set of quality practices are being followed or not. We need to see the RC CAPA process, wherein whether the required root cause, corrective and preventive action are taken or not, if any quality problem is identified in the whole process. We can also do a surprise checking at the quality process, where intentionally we can add a defective item in the WIP to check whether QC will hold such item or not. So if the QC, so this particular audit check can be done only when you take a prior permission from the top management and the plant head of that particular unit. And if you get a go ahead, then you can, without informing to anyone, but only a concerned authorized person, you can add one defective item during the WIP stage, and you have to wait till that FG is converted to that WIP is converted to FG, and it should clear the quality process. If the quality team clears that process, that it's a clear case that the quality team has not, stopped that defective item. Then, as an internal control, what we have to see or suggest, we can see whether the stringent quality checking procedures are followed or not, the required set of quality practices and procedures are in place, and the regular quality audits should happen in the company. If all these things happen, then this kind of thing may be avoided in future. Moving on to the next one. So this is again related to quality assurance, but it is also linked with the procurement process. Now here, the early warning signal is substandard raw material quality accepted and used for production. Now, it is leading to your excess wastage or rejection, leading to excess working capital usage or working capital blockage. Now here we mean that the material which you have purchased from the supplier is not having the required quality, not meeting the required quality standards. So, and it has been accepted, not stopped by quality, incoming quality, and has already been issued for the production also. So once it is issued for production, which is a defective raw material, so it will definitely lead to some, say, loss at the WIP stage or loss at the FG stage. But since we have already accepted from supplier, the company has already paid for that material to the supplier, which is a clear loss to that company for that defective material. Now, behind this early warning signal, there could be multiple reasons. One could be your, say, incoming quality person and purchase executive have a collision, and they have in discussion with supplier intentionally accepted the substandard raw material, so which is giving a definite favor to the supplier. This could be one thing. Second thing could be that the required set of quality procedure or practice are not being followed at the receiving stage. So if this particular material, defective material, could have been blocked or stopped at the receiving stage itself, it must be returned back to the supplier and not accepted for the production. Now, what data we need to check for such kind of cases? We can check the rejection and rework records. We can check the inward quality checking process and records. We can check purchase order issued to the supplier, whether the supplier has been informed about the desired quality norms through that purchase order or not. We can check the QC certificate submitted by the supplier. Now, in many of the cases, you can take an example of FMCG items. We can take example of, say, some cosmetics item or pharmaceutical companies. All these, kind of industries, whenever they purchase a material from their supplier, they also ensure and ask supplier to submit the QC certificate from the supplier. If the QC certificate which is coming from the supplier from the authorized lab is having the required parameters in place, then the incoming quality team can accept that. But if any of the material is not within the required parameter in that QC certificate, or QC certificate is not there at all, then the QC team should not accept that material and it has to be returned back to the supplier, asking to again return the material along with the required QC certificates in place. Now, if we identify such kind of the early warning signal or audit observation, we need to check upon the internal controls. Now, first could be quality check control over raw material received for production, which I've already explained that the material which we are receiving from the supplier is meeting the desired quality standards or not. then levying penalty or vendors for quality defects or rejection. So for this, we need to see the supplier ledger. If the supplier ledger has any such accounting entry with respect to the debit note given to the supplier for quality defects, then we can have a assurance that the company is following the right practices. We can also see the purchase order terms. That purchase order terms defines that if any particular quality defect is happening, then we can't accept that material and it has to be returned back to the supplier, or debit note will be given to the supplier. And keeping proper records of quality tests for future course correction and vendor reconciliation. So many times it happens that the company does not keep the record and the material has been rejected. Now we don't have any backup document in place to fight with that vendor that the material was defective, and that is why the FG or WIP was the defective which is produced. So if we ensure these kind of internal controls are being followed, the company or the manufacturing unit can safeguard itself from such kind of problem in future. Moving on to the next one, this is related to procurement and inventory. Now, this is excess purchase of material leading to inventory accumulation. Now, inventory turnover ratio could be low in that enterprise where we are purchasing over our requirement. So, for example, to produce 100 units of FG, we need to have 50 units of WIP, raw material, sorry, but we purchase 80 units. Now, that extra 30 units will be accumulating in the stores or the warehouse, which is impacting our working capital and also resulting in low inventory turnover ratio of that enterprise. Now, low inventory turnover ratio is very easy to find out from the books of accounts. Once you find out that the inventory turnover ratio is very low compared to their previous trends or the industry standard, then you can go into detail, and for that in-depth checking, you can see on that risk whether that excess purchases are not being done. Now, what data needs to be checked for such audit check is, one is purchase requisitions. So whether the purchase requisitions are properly coming from the authorized person, whether reorder level are in place or not. So by reorder level, I mean that the system should be capable enough to initiate a requisition or the order whenever the material reaches at a certain level. Say, for example, we have kept it 10 units as a reorder level for a particular item. Whenever in the stock ledger that inventory reaches to 10, the system automatically creates a purchase requisition and it goes to the purchase department for creating a purchase order. So this kind of auto system will ensure that there is no manual intervention for raising a requirement to the purchase team. Then we need to see the inventory aging reports also. Inventory aging report will give you a clear indication about whether that a particular item code or particular set of, say, item category is not kept it for so long. Say, for example, any particular item code has been lying there in the company for more than 6 months or more than a year, it's not been used and there is no movement during the year on that item code, then we definitely need to get into detail about that item and its history. We also need to see that there is no purchase of such items, and there is an automatic system in place where if an item goes beyond a certain age, your purchase order should not be prepared in the system. It's an auto ERP control that we can suggest to management. If system stops at automatic creation of purchase order for such aged inventory items, then we can definitely safeguard from such situation in future. Then, as already explained, we need to see the inventory turnover ratio also. Then what are the internal controls that we need to see or we need to suggest? We need to have the safety level. We need to have reorder levels for running stock items. Now, safety level is something which is below reorder levels. Now, as reorder level, I've explained that reorder level is something where if the item goes at a 10 unit, then automatically system will create a new purchase requisition. Safety level is a slight below reorder level also, where at any given point of time that inventory should not go below the safety level. Now, safety level and reorder levels are being prepared in the organization considering various factors, which is involving your production plan, which is involving your bill of material, which is also involving your lead time for purchasing that inventory from our vendor place, that how much time is required from giving an order to the vendor till receiving of that material from the vendor, like how many months, 2 months, something like that. So all these factors are being considered for defining the safety level and reorder level for the stock items. Then we can also suggest internal control with respect to regular review of purchase, consumption, and closing stock. If this kind of regular review, not by auditor but the management, is happening, then such kind of situation will be definitely identified before any material losses will happen in future. Then we can also have the internal controls of monthly review of inventory turnover ratio. By monthly review, we can see the trend of the inventory ratio. If the trend is going smoothly and there is no uneven curve in the overall monthly trend, then the manufacturing enterprise is going on the line. But whenever there is a sudden spike or any uneven thing that has been noted out in the inventory turnover ratio, then we definitely as an auditor need to go into detail to see that and such kind of situation is not happening in behind. Moving on to the next one. Now, this is related to inventory and finance. Now, by this thing, we mean that the early warning signal is non-moving or aged inventory leading to working capital blockage. Now, here we mean that inventory aging report we have identified, we have taken out from the system, and the inventory aging report, we have found out that a lot of materials are lying for so long and there is no movement in that inventory, in that stock items, that we need to go into detail about that inventory, that why particular inventory was ordered. Now, what are the data we need to check for this thing? We need to check the inventory turnover ratio, as already explained in the previous slide. We need to see the reorder level. We need to see the subsequent purchases of such items already lying in stock. Now, for this thing, we need to take out the complete dump of the purchase orders during that period. We need to see the complete dump of the goods received note, like GRN report from the system, and to see that how much we have purchased, when we had purchased, when that material has been received in the premises. Then we also need to see the stock movement analysis, like stock movement reports can be there from ERP, which gives a picture about that how much material has been issued from the store to WIP and how much material has been converted from WIP to FG, like finished goods. So, taking the complete picture as in a holistic view, we can find out that whether material which is already lying in the store, whether if it is not in use, then whether purchase team has ordered that material or not. If they have ordered, then whether material has been received or not. If it has been received, then whether that material is being issued to the store or not. Now, we also find out in many places where the material which we have ordered subsequently has been received and has been issued to the production floor also. Then we question that what happened to the previously lying material in the inventory aging report. Then we have to conduct the physical verification also of that old inventory aged items, and many times it came to know that there is no physical inventory which is lying. It is only the book stock which is lying there, and physically there is no material which is lying there. That is the physical verification unearth this activity or this event where physically there is no material and the company has to write off that old aged item, which is a direct impact on the P&L. Then we also need to check the auto blocking of PO in case of breaching maximum stock level. Now, what is a maximum stock level? This is again an important element to be seen, that as we have discussed in the previous slide, that one part is one is safety stock level, one is reorder level, and the third one is maximum stock level. Now, maximum stock level is a level beyond which the stock level should not go, should never go, beyond that level. So that means that, say in our previous example, 8 units were safety stock level, 10 units were reorder level, and say 25 units of that inventory is maximum stock level. Now, whenever due to the regular purchase of a certain inventory, the stock level of that particular item comes at 25, then there should be a auto control in the system or the ERP to block subsequent purchase order. So system will not allow the purchase team to make a new purchase order for such item which is already reaching at a maximum stock level. Now this auto check will ensure that the company should not receive the excess inventory in the premises, which is safeguarding the company from, say, working capital blockage. First thing. Second, you're saving from the warehousing cost because you are keeping the material for so long in your warehouse. So again, warehousing loss. Third, that if you have so much stock in your, then you can't keep the stock properly in the store and ultimately impact your the stocking as well in the store. Then what are the internal controls that that are desired for this activity is the safety reorder level and maximum level that we have discussed. Then we can have the regular review of inventory position. Now regular review of inventory position means that what is the inventory consumption at different point of time, how many times your inventory levels have gone at reorder level, how many times your inventory levels have gone to maximum level, how many times your inventory levels have gone to safety stock level, what action the company or the concerned team has taken whenever the stock levels have reached to that certain level, whether any there is any revision in the inventory levels during the your audit period or not. So all these things becomes a part of the required internal controls. Then inventory liquidation plan, it's again an important activity. Many times it happens that inventory gets accumulated year on year in the company. Now whenever this situation happens, now there could be two scenarios. One could be your inventory is there in the books but not there in the not there physically, which I have already explained in in this recent example. Now if inventory is not there physically, then it is very important for the company to write off that inventory from the books, but it can be identified only when that whole deep dive is being done into this whole activity. Now this will the writing off from books will give a direct impact on the P&L in that particular financial year also. Now, second scenario could be that material is also lying physically. Now, if the material is also lying physically and it is there in the books for so long and not being used and there is no movement in that inventory during that whole year or whole period, then the question comes in whether management or that the manufacturing plant, whether they genuinely need that inventory or not. If they don't need, then what is the purpose of keeping that inventory in the company, in the premises? We need to have the liquidation plan also in place and to liquidate inventory to ensure that we free our working capital, we free our warehousing space also, and to liquidate and to get the cash in our pocket. Moving on to the next one, this is related to scrap management. Now, in scrap management, this is something which is generated as a normal production activity. Now, errors in scrap sale, there could be high scrap sale versus sales and production. This is an early warning signal where when we identify or we analyze the scrap generated and scrap sale during a particular period, and we compared it with the sales and production during the period, and we did a period on period analysis to find out whether everything is in place or not, and if such kind of uneven trends are being found out. That uneven trend means that at certain period we found out that for every 100 units of material sold, we have 5 rupees of scrap sale in a general trend, but sometimes we found out that for every 100 rupees of sale, we had 28 rupees of scrap sale. Now 28 rupees versus 5 rupees for same 100 rupees sale is a clear gap. So now this is a early warning signal that many instances or many root cause could be there behind this situation. One could be incorrect scrap sale price, because here we are analyzing value to value. So there could be a situation that the scrap is not sold at the right price. It has been sold at a higher price. This could be one thing. Then incorrect scrap quantity built. That means that actual scrap was generated the right quantity. However, when we are selling the scrap, that incorrect quantity has been built. Then delay in scrap sale proceeds collection is also a problem in this whole scenario. Now, what is the data we need to check upon? We need to see that bill of material, that for generating that 100 rupees sales, what is the input that is going to consumed by the company. So which will be found out from the bill of material only. We need to see have the surprise visit at the scrap yard also to see that what is the procedure of scrap management, scrap keeping, then storing of that scrap, then loading of that scrap in the on the say the vehicle which has come for picking up that scrap, and all these practice. What is the process of weighment of the scrap as well. Surprise checking of scrap loaded vehicle is also a very important activity that we can follow, where we can, once the scrap has been loaded and a surprise basis, we can stop a loaded vehicle and we can check whether any good material is not loaded on the scrap items. So this is also a kind of fraud which can be done by if the security team and the scrap management, scrap yard team and production team that collided, then this kind of fraud they can do. Then scrap payment report also we can check. And what are the internal controls that we need to see? One is that approved scrap sale price from management, that all the scrap sale prices which are there in the system are approved by management, and there should not be any manual intervention for putting up the scrap sale price in the system. So prices should come from the price master, ideally from, if it's a ERP based scenario in the company. Then recording of scrap generation and scrap sales, we need to see that whether the scrap generation is recorded properly at the right time, and once it is being recorded, then it is properly transferred to the scrap yard. And if it is transferred to the scrap yard, then before scrap sale, there is a proper mechanism of weighment in presence of security, in presence of scrap person, and in scrap presence of the concerned production in charge also, production supervisor also. Then reconciliation we can do of generation versus sale quantity to ensure that the right quantity of scrap sale is reported and is being billed. So if we have all these controls in place, we can give a certain level of assurance to the management that the right controls are in place for scrap management. Moving on to the next. This is related to the inventory management function. Now, in the inventory management, one early warning signal could be that consistently we are finding gap or the shortages in the inventory physical verification. Now, once the inventory physical verification is being done by, say, independent activity, maybe by independent audit team or maybe by independent team in the same company, and consistently we are finding that there is a gap in the physical verification, then we need to go into detail and to check out that what is the reason behind the difference. Now, there could be different scenarios. One scenario could be that, which is a real life example, that same inventory difference is reported month on month. That means there are 1,000 odd items which were physically verified by the auditor. In certain 15 odd items, there were, say, 2 units or 3 units difference in 1 month. The same units also had the same quantity difference next month, and in the 3rd month and the 4th month also. So when we go into detail for checking the root cause behind this problem, it was identified that multiple reasons. One, that the physical verification which was conducted for the first time, there was no inventory adjustment which was conducted by the finance team based on the reports given by the physical verification auditor. So that means that what is the purpose of conducting that verification if there is no inventory adjustment duly authorized by a proper person is not taking place in the books of accounts, because it is not meeting the purpose. Second reason could be that the inventory verification was not conducted properly, and it was just a mere activity of taking, and the verification was conducted by a person inside the premise, inside the one of the employee of the company only. So he was just meeting the requirement fulfill and not going into the actual physical verification. And there could be also difference reason behind this difference, like excess material consumption. There could be unrecorded production that we have discussed in the previous slide, unrecorded sales that we have discussed in the previous slides, and unidentified theft also. So if physical verification is a detective control, which is an early warning signal, and we should, as an internal auditor, not should only limit ourselves to checking whether the physical action is conducted or not, but we should also go into detail into deep of any difference which is reported by the auditor, and to check what is the root cause behind the difference. So because this could be just a tip of an iceberg, but if we go into detail, we can definitely find out that there could be multiple reasons behind the difference also. Now, as I've already explained that what are the data we need to see, we can check the inventory PV records, we can check the production records, we can check the bill of material, we can check the input output records, and we can check the sale record. Now, you can note that all these records we need to see once we have identified the tip of that iceberg. So identifying the tip of an iceberg in this scenario is very important, and once identified that, we should go and check these records in detail to find out the root cause and the action taken by company to against that difference of physical verification. Then moving over to internal controls, in such cases, we can have a periodic and surprise physical verification regularly. There is a term called perpetual physical verification also. Now, perpetual verification is a continuous inventory verification wherein the company identifies or segregate the stock into class A, B, or C. Now, class A, B, C can be made based on different factors. Some of the factors could be value, or the usage, like periodicity or frequency of usage of that item, could be materiality to that particular company. Maybe it is a nut or bolt, but it is a very, very important item, then it comes under the class A. Then class B could be, say, little expensive, or so a little, you can say, important or less important than class A category, and similarly class C category could be least important, or the least expensive of all these three category of items. Now, in the perpetual inventory verification process, the store department continuously keeps checking of class A, B, and C item as per the defined periodicity, to ensure that on any given day there is certain quantity of inventory getting checked, to ensure that any given day of time in the year, the store or the inventory record give a correct picture. Then point number 2, maintaining proper inventory records for receiving, issue, consumption, return, dispatch process. Now, proper records you can check by doing data analytics, by doing surprise checking. Like surprise checking means that you can go at the shop floor, you can go on the store, and you can check that in the last 5 minutes, what is the inventory that you have issued. Please give me the material issue data. You can see that whether the material issues have been properly made or not, whether the material issue slips for last day, immediately previous day, has been updated in the ERP or not. If they are not updated in ERP, that means there is a time lag between actual issue of material versus material issue recording in the ERP. Again, it will lead to inventory defense. Then material return from the shop floor. There could be some scenario wherein the material has been returned back to the shop, from shop floor to the store. Whether the store is properly capturing such returns in the store's records and the ERP or not. In case of dispatches, many a times we have seen that dispatches have happened on the basis of the manual invoices and not captured in the ERP on the timely manner. In such cases, if the dispatch person who is in charge of invoicing, if he is not invoiced it correctly in the ERP, and it leading to the time lag, then there are high probability that this will naturally lead to a gap between physical and books inventory of FG. Then recording of WIP stock issue and balance. Basically, so WIP stock is not recorded properly. So how many WIP stock has been kept at a month end or a quarter end or a year end, and whether the WIP stock has been properly recorded or not. That payment of the WIP stock is also important in many industries, like paper industries or any industry which is using some kind of material which can't be quantified in terms of units. So the correct payment at the correct time is definitely an important element here. Moving on to the next one, this is related to the dispatch, logistics, and revenue recognition. Now, in this area, there could be an early warning signal where we could find out a scenario of delay in dispatch, like FG has been produced but not invoiced, or invoiced but not but delay in dispatch. That means at a period end, material has been produced and has been kept at the dispatch yard, but it has not been invoiced to the customer. Okay, but in some cases it has been invoiced also, but not dispatched, invoiced but not dispatched. So in both the scenario, there could be the risk related to this is one is delay in revenue recognition, and it is ultimately leading to working capital blockage because we are not able to give that invoice to the customer, leading to ultimate realization of our debtors. Now this is a early warning signal, and if we go into detail, we can find out that there could be multiple reasons behind that. So one of the reason could be that there is a month end or quarter end pressure on the production team, and they need to meet out their production targets, and to meet out the production target they have produced, given and taken into the consideration of the production plan, and they have built up their FG stock at a period end. Now building up the FG stock at period end has ultimately leading to FG coming into the books in the P&L and the balance sheet, but you are not recognized as a debtors because you have not invoiced it to the customer first. Second thing could be that you have invoiced because there is a pressure on the sales, because sales wanted to give a rosy picture in the books of accounts about their revenue. Now revenue can be recorded only when you have invoiced the goods to the customer, but you have invoiced but you have not dispatched. So that means that the revenue recognition policy can't be followed as per the accounting standard, and there is a delay in revenue recognition. Now, what are the data that we can check? We can check the revenue recognition policy of the company. We can check the dispatch schedule versus actual dispatch records. We can check the delivery confirmations by the customer also in such cases. Now, what are the internal controls? One could be production to be done based on approved sales orders only if it is a order to make industry. Now, next, electronic record to be prepared for entire process end-to-end, like sales order, production record, FG conversion, invoicing, and dispatch. If there is end-to-end electronic records are in place and every record is correlating with the previous record with a unique number, then in such cases, you can find the audit trail. And against that audit trail, you can see the relevant audit sections. Then point number 3, timely identification of non-invoice stock and to follow up with the customer for timely deliveries. So we can see such kind of cases also as an auditor, and identifying such customers who take delayed delivery and negotiating with them during next order. Now this point number 4 is like many times it happens that company has made production based on the order from the customer, but now customer is denying or delaying the delivery. Now, in such cases, the stock is being kept in our premises or in our FD warehouse only. Such cases also is impacting our working capital or revenue recognition. Now, I hope I am clear till now. And moving on to the next one, this is related to the receivable management. This is incorrect sale price used for billing. Now, in this kind of case, it's a clear case of loss of revenue because your billing has been done at lower price. For this, what data we can see, we can check the sales invoice data for an entire period with respect to customer level analysis, with respect to product level analysis, and time level analysis. Now, many times it has been noted that what we identified in past also, that the company changes or revises the price. Now the price revision gets impacted on a certain day. Say for example, from 15th April 2024 onwards, our prices are going to change. Now, the company has declared this policy pan India. Now, if there is a lag in any of the process cycle, and due to some reason they are not able to change the price on time, say on 15th of April, and your billing is not stopped on 15th or 16th, then your billing will happen at the old prevailing price only, which is leading to loss of revenue to that company. Now, this we can check through review of price master change log, your management approval, price master, list of approved prices with change effect data. So if we review this data in detail, we can find out whether the prices have been revised in the ERP at the right time or not, with effect from which date, which definitely should be as per the approval given by the management. Now, to check this, what are the internal controls which are required? The sales orders in Tally, approved sales price from management, sales orders in Tally or ERP approved from management, regular review of approved prices and actual sale prices. This we can review. And so this is related to receivable management. Next is related to debtors turnover ratio. Now, high debtors turnover ratio is also an early warning signal for any enterprise because it is impacting our the working capital, because leading to delay in collection from customers. Whenever there is a high debtors turnover ratio, maybe during a certain time period or continuously in that enterprise, we need to go into detail to identify the root cause behind that problem. Now, this problem can be because of various reasons. Now, we need to check the credit policy of the company. We need to see that what is the authorized credit that a company can give to the customers. Are there any instances where we have given credit to a particular customer in excess of the approved credit policy? Say, for example, the credit policy says that we can't give credit in excess of 60 days to any customer, but your some of the customer have are enjoying the credit days of say 90 days or 75 days. Then what is the exceptional approval, or what is the mechanism of you know of such kind of cases? Then we need to see the payment terms which are agreed with the customer. Now, payment terms, we mean that whether it is an advance, whether it is say 30 days credit, whether it is 45 days credit, or say on so on. Now, what is the credit payment terms which is decided by that with the customer is properly recorded in the customer master or not is a very important audit check, because many times it has been seen that sorry, many times it has been seen that the payment terms or the credit terms are manually altered by the person who is creating a sales order in the ERP. So that means that whenever we have onboarded a particular customer, we record the credit terms of 30 days in the customer master. But whenever the person or the person who is in charge of creating a sales order in the system in the ERP, he has access of manually altering the payment terms. So what he does, he changes the payment terms from 30 days to 60 days, giving an extra favor to the customer, which is unauthorized favor. By giving this, or altering the payment terms in the sales order, it is floating to the sales or from sales order to sales invoice, and from sales invoice, it will flow to your aging report. So your aging report will also be prepared based on that payment term which you have entered in the sales order. So leading to your high debtors turnover ratio. For this, we need to see the change of also, and we need to see the sales order report also for an entire time period. And if we find out such kind of cases where same customer has different payment terms at different time period, and we don't find any backup document or authorization or approval from management for such kind of difference in the payment term, then it could be a clear case where the payment terms is intentionally modified by the person entering the sales order in ERP. We also should do the ERP walkthrough to check whether that person is genuinely having a manual alteration right or not. If it is there, then we should take a screenshot and we should report to the management and the IT team also to block such kind of manual alteration changes, the right. Then what are the internal controls which are suggested against this early warning signal? One is access controls for changing payment terms, which I've already explained that if the payment terms can only be altered or should only be altered by an authorized person in the customer master only. It should not be done in the sales order report, because if it is allowed in the sales order report, then the person who is in charge of sales order can do anything as desired by the customer, because the person has the flexibility to alter that the term. Then second, regular review and reminder to debtors. We can check whether there is a mechanism of periodic extraction of and preparation of debtors aging report and giving a reminders to debtors, whether we have the right credit check in Tally or ERP, wherein the subsequent sales order or the invoices get blocked before your previous overdues are not cleared by the customer. Control over sale price or discount to non-performing customers. So that means that at one place we are saying that the customer is not giving us the money on time, and at the other end the marketing or sales team is continuously giving the schemes, benefits, discounts to that same customer. So that means the customer is enjoying the double benefit from the company. So we need to see such kind of cases, or such kind of control should be there in the policy level in that company. then we also need to see that whether annual data performance review process is in place or not. Now, in many of the companies that we find out is the customers are not being evaluated based on their performance. We generally company has a evaluation mechanism for their vendors like suppliers, but for customers, the companies don't do that performance evaluation because they see that we as a customer it is important for them to feed, but many times it happens where if the debtors turnover ratio is increased at a certain level which is very high, then is it starts impacting the working capital of the company. So it is imperative for the company to periodically evaluate the customers and the debtors based on their performance. Performance could be on many factors, out of which your timely collection is one such aspect. Now, moving over to the next one, this is related to the logistics. Here, early warning signal could be inconsistent transportation cost for same route. Now, as an example, you can see that moving from Delhi to Jaipur, the cost of transportation is say 100 rupees for X kg of item. Now, inconsistent transportation cost means that in some of the cases it is 100 rupees, some of the cases it could be 120 rupees. So this is one case. Next case could be at a more macro level. We found out that uh, certain customers, when we are sending goods from factory to certain customers, there is no transportation cost at all. Okay, and however, in some of the cases, in same customers, there are transportation costs incurred by the company. So that means there is inconsistency. Some of the orders, there is transportation which is borne by the company. In some of the cases, transportation was borne by the customer itself. So that means it's a case of early warning signal to go into deep. When we go into deep, then we can find out that the root cause behind this problem could be manual changes in the delivery terms by person while creating sales order in ERP, leading to transportation borne by company for X works deliveries. Now, what does this mean? That in X works contracts with the customer is liable to take the delivery from the company's or the factory's premises. Now, company or the factory will not be required or liable for delivery to the customer end because it is an X work contract. However, in some of the cases, if we find out such kind of cases when the X works contract company is only meeting the transportation cost, then it's a clear case of audit observation not meeting the delivery terms agreed with the customer. Now, to see this, we need to see the delivery terms agreed with the customer. Naturally, we need to see the customer master. We need to see what is the agreement which is signed with the customer if it is there. We need to see the sales order term from ERP, customer ledger, and transportation invoices. Now, again, as discussed in the previous example, this is also a clear case where the sales order was manually altered and the X works delivery terms was amended to CIF. So again, giving an extra favor to the customer. So once this was done, the sales order, the invoice was also generated not based on X works deliveries, whereas it was generated based on CIF delivery. By looking at the invoice, the warehouse team and the logistics supply chain team thought that the company only has to give the delivery to the customer, and accordingly they unleash the vehicle and send the goods to the customer premises on their own cost. What is the preventive action that the company can take to stop such kind of cases in future? The person creating sales order in ERP cannot change the delivery terms. It's a very, very important IT control which the company should be implemented. Then detective control could be that weekly review of transportations done vis-a-vis delivery terms agreed with the customer. So to identify if any such kind of cases are happened during that particular week, then immediate action can be taken by the company and the recoveries can be initiated against that customer for such kind of cases. Okay, so I hope I'm clear by till now. Then next is related to human resource management. Here, early warnings, this is a risk of ghost employee. Now, to identify ghost employee risk, there are some early warning signals which are written in red here. First is no deduction from salary, wages, or gross pay. So that means that if there are ghost employees created by the HR personnel of an organization to take home that ghost employee salary in their own pocket, the such people or such ghost employees will be paid every time at gross pay. Like means there are no deductions from the salaries. There won't be any leaves during the year. There won't be any overtimes by that ghost employee. So that means there are no leaves taken by that person or ghost employee during the year. Same punch and punch out times every day. No punching in canteens. So at many of the big canteens or big the multinational companies or the factories, there are cafeterias or canteens. So whenever the employee is going for the lunch in such canteen, they need to punch their card. So if this employee ID is a ghost employee, then you won't find any punching in the canteen records. Then no attendance in the get together or office parties. Many a times, factories or they do some get togethers or parties. So HR needs to have the attendance record of the people who have attended such get togethers. So if such kind of cases of ghost employee, then ghost employee will definitely not have the attendance captured in their such kind of get-togethers. So these kind of early warning signals, if you find in any of the audit, then you can go a little deeper to find out whether any ghost employees are there or not. Now, the data which needs to be checked, we have already discussed here. And what are the internal control which we can have in place? One is preventive control, like authorization control. Authorization control means that who is the authorized person in the company to create a employee code in the system. Who is the person in the company who can update a bank account of an employee in the system? Then are there any maker checker in place or not? Maker checker means that one person is updating a record, another person is checking it in the system and giving a go ahead. Then SOD in employee master updation. SOD means segregation of duties. That means that one person should not be given responsibility of the conflicting rights. That means person who is in charge of payroll processing should not be the in charge of updating the employee master in the ERP. So this is a case of segregation of duty. We can have some detective controls like weekly reconciliation of different data as mentioned above with attendance records. So you have different data like leaves data, you have the attendance data, you have the punch in punch out data, you have the canteen data, payroll data, something like that. And on periodic basis, you can do a reconciliation to find out such early warning signals. Then you can also have a system control of auto alert from system based on predefined rules to highlight such cases. Like, are there any employee who has not taken lunch in the entire 2 months? Then there is an automatic alert which can come from the system and report it to the right set of people. Are there any person who has same punch in and punch out time every day for continuously 30 days in a month? Then the system can automatically, based on predefined rules, system can automatically fix such employee code and can report. So such kind of auto alert can also be generated from the system. Then next, it's again a kind of fraud which can be there in a procurement to pay function of bribery or kickbacks by the suppliers. The various you can say the early warning signals could be the several concessions which are given to the supplier by procurement staff. Concession means that suppliers are given extra credit period. Suppliers are given, the no negotiations are being done with some kind of suppliers. So the suppliers are always giving a good treatment when they come in the company premises in comparison to the other suppliers, things like that. Then there could be early payments, like credit period has been decided of 30 days, but the supplier has always paid say before 30 days, like 15 days or 10 days, like that. So this is an early payment to the suppliers. Then buy more than the required quantity. That means that your requisition is for 100 units, but you have keep an order of 120 to that supplier every time. So every time there is a PO, purchase order quantity, more than the purchase requisition quantity. So this is a case of giving extra benefit to the supplier. Independent quotation from other suppliers are not taken, or inadequate measures while conducting technical or commercial comparative. Now, in the technical comparative, you have not considered certain factors from this supplier, but considered from other supplier, and you have rejected the other supplier based on that factor, which you have not considered against your preferred supplier. Commercial comparative means that the price quoted by two suppliers are same, say 100 rupees, quoted by both suppliers, but this supplier is giving extra payment terms to you, one supplier giving preferable delivery terms to you, things like that. Then what are the internal controls? One is authorization control, that who is authorized and person in the company to onboard such suppliers. What is a maker checker control, like whether one person or one set of people are only involved in technical and commercial evaluation and there is no segregation of duty. That preventive controls also covers that whether we have the required set of SOPs with respect to who can send the request for quotation, to whom the RFQ has to be sent, with a copy marked to any independent person or not, like finance. Quotes receiving from the suppliers, whether the quotes have been received by a person independent of the person who is in charge of analyzing the comparative the quotations, whether the opening and analysis of quotes are done in presence of a third person or not. So things like that. Then detective control means periodic audit of high value purchases and new vendors onboarded. If we can have such kind of periodic audits in place of say certain high value items or new vendors onboarded with respect to these the quality parameters, then we can give assurance to the management with respect to no such wrong practice being followed in the company. So, friends, I'm sure that the examples that we have discussed so far, I am able to deliver a certain level of, say, practical, the case studies with you. And if you have any query, we are free to take. But just 2 minutes more, I can take, say, how to find early warning signals. So, the example that we have gone so far, to find out such kind of early warning signals, it's important to have the risk register in place. We should understand the process in depth. We should understand the data prepared at various stages, like we have discussed in every example. We should once understand the data, we should prepare the process flow along with the data points at different data process flow to find out that the required data set is analyzed and reviewed upon by you at different audit checks. Then various methods of identifying early warning signal could be data analytics, surprise checks, physical verification, reconciliation, or review of audit trail. And as already discussed in previous slides, any of these 5 measures were only applied upon to find out the early warning signals as discussed above. Now, once we do such analysis, what have you found this? What have you found? You have found only this part, which is what? This is only a tip of an iceberg. But the activity is just the beginning. It is just the beginning, because once we found out a tip of an iceberg, which is an early warning signal, we need to do a detailed data analytics. We need to do a base records verification. We need to do cross checking of various records. We need to do interviews with auditees. We need to do historical data analytics also. We need to do detailed internal audit checks. So this is just a beginning, not an end itself, because many times the internal auditors feel that this particular thing has been found out and they report it in the audit report. But the activity is just the beginning, not the end itself. So now we are open with the query. So I request, if anyone has any query, we are free to take that query.
Thank you so much, sir. Very good and very thoroughly you have taken. I have few questions are there. I'll take up just a second.
Surely, Kirti.
First question is actually it is will there be any material provided subsequently, or whether you will be sharing this PPT? I think that person is asking.
Yes, so I can share it with Institute, and I think the registered participants will definitely get the PPT. Yes.
Okay. And the second question is, where can we find the necessary compliances that the unit needs to follow?
The compliances mean statutory compliances.
Yeah, I think the necessary statutory compliances.
Okay, so this is statutory compliances thing. There is no because the government libraries are there, but government libraries are no, they have the acts uploaded on the respective government portal. So the person may find it at different private parties are operating in India, like some kind of softwares are prevailing which gives this functionality that you put in that industry and that industry related laws will come in. But as on I suggest that particular auditor need to do his or her own research.
Yeah, that is because it is related to the industry to which you are doing. So it will be better you do your studies.
So what in our particular case, what we did, based on the experience, we say we have covered FMCG industry. So FMCG industry, we prepare a checklist. So it will be handy when you go into other industries.
Yeah, it will be different for a chemical industry. It will be different for
yes, like that.
Very true. So the second question is how to find EWS. A slide can be shown again. How to find EWS slide she want to see.
Okay. I'll again share my screen. Okay. My screen is there, visible.
Yeah, it is shared.
How to find this? Okay.
Yeah.
Right. So I'll explain this particular slide again in brief.
Yeah,
So,
and of course, PPT will be shared, so the participant can of course see this. Yeah.
So this is a basic audit methodology that we have to follow. This is, preparing a risk register that identify what can go wrong in each process, because we need to wear the hat of a thief. Because as we always say that police can catch a thief only when police thinks in the way a thief
Right.
thinks. Exactly the same case applies to the auditors also. We need to identify what can go wrong in each process and how can a perpetrator can do that wrong. We need to see that. We need to understand first that. Then understanding the process, preparation of the process flow, flowchart, diagram, data points, and analytical reviews. That is the only thing that we have to follow.
Do we have any specific frameworks which can be used to identify EWS, like any rating or scorecards? I think you have explained how to go through one by one. You have to check all.
Right,
Better
sir.
you.
So there is no scorecard per se, because it again depends on industry to industry. Like scorecard is like an industry can make it for itself. But as a standard audit methodology, we need to go from step 1 to step 10. So step 1 is what? Risk register. Step 2 is what? Risk and control identification, like that. So if we go into same detail, step 1 to 10, then we can be able to identify EWS.
Many questions are related to PPT only.
Okay.
I have few
Yes.
You were saying about the scrap sales, right? So
Right.
one thing we can also check ki scrap sales ki vendors ko proper, they should take quotations for scrap sales. Vendors or TCS cut kiya hai ki nahi
Yes.
proper.
Correct. So TCS is a statutory compliances, है ना? So the objective that we were discussing about was fraud. कि fraud कैसे हो सकता है?
Okay.
उस केस में क्या होगा कि the example which I gave कि आपका गाड़ी was moving out of the premises and that scrap vehicle was also having the good material.
Okay.
तो आपका क्या हुआ कि आपका फिजिकल प्रोडक्शन हुआ 100 यूनिट्स, पर आपका एफजी फिर आपका स्क्रैप फिर भी ज्यादा हो गया. Why? Because आपका एफजी में तो एफजी मतलब स्क्रैप के अंदर एफजी मिक्स था.
FG भी चला गया. Okay. And the second question I had, data's turnover में जो आपने बोला था, data's turnover ratio. तो can we also check MSME compliance अपना if that unit is MSME registered? So nowadays they have this, so whether they have informed about the MSME registration to them or not. So that उसकी वजह से भी they can collect a good rate of conversion will be there.
Right. 100% agreed. But again, I'll repeat the same thing that the way we would, this is a statutory one, because the way we were discussing was a fraud angle. Why, how the person can give of extra favor to that customer.
Yeah.
वो things.
So, slide number 29. So someone is saying, please show slide number. Slides will be shared with you participants.
Yes. So slide number 29 is how to find early warning signal. This we will share with all.
Yeah, so we will be sharing all of the full PPT with you all. So initiate. So one question is, do you mean that we should initiate an investigation based on our primary findings? Would we cross our boundaries as IA, internal auditor, if we start the investigation without properly buy-in from the audit committee?
That's a very, very valid question, actually very important question also. So I'll definitely would like to give a reply on this. First is that internal audit standard has one of the standards which says that considering fraud in an internal audit. So this is an internal audit standard itself. So what we have discussed so far in today last 1.5 hours is considering fraud in an internal audit. So we are not the fraud investigator ourselves, but we are considering that a fraud may happen. So we have to identify a red flag and we have to report it to the management through an audit observation. So we are, that is why every time I've repeated the word of interview. I did not say interrogation. So when we are wearing a cap of a forensic auditor, we need to do interrogation against that person who is a perpetrator. But if we are internal auditor, we need to do interviews against that, interviews with that person to take that information. That is why we can't say that we are doing a forensic investigation and fraud investigation every time. But yes, we at every internal audit we need to keep that consideration in our mind that a fraud may happen, may not happen. It's very good in that company, so we can find out internal control gaps and we can just suggest the control opportunities or things like that. But if we won't keep that consideration in mind, that definitely we will not be able to find out that red flags. I
So
suggest
when
that maybe the question that participant asked, he or she can go through that internal audit standard also. This is a very very valid question as well. That standard also, that internal audit standard can give that reply in detail.
So Nisha Doshi has this question was asked by Mr. Sandeep Kunte. The next question is there: should ITGC be a major focus area considering the automation in the industries?
Yes, definitely it should be there. So ITGC has two parts. One is the IT configuration part. One is the IT operational part. So I have also told you certain IT controls in my PPT. Although I am not the IT expert, but IT operational cheezein, like the things that we wanted to there in the system, we can suggest, we can check. But how the controls are built into the system, we can't check. So for that, IT expert should be there. We need a help of an IT expert if that such kind of assignment is given to us.
Mr. Mahesh is asking, where can I find this webinar presentation in ICAI website? So I'll ask the tech team to guide you on this. Okay. Any more question? Yeah, we have few important standards we have to keep in mind, sir, during internal audit. Can you guide on some few standards which we should?
Yes, definitely. I have that thing also with me. If you can just allow me for a 30 second, I can just open that. There are many standards, but some standards are very, very important to be keep in mind. I'll just share my screen again.
Yeah.
I hope my screen is visible.
Yes, sir. Yes, sir. Yes.
Okay. So here on the screen, you can see that there are some basic principles and there are some standards. So the ones which I've highlighted in green tick, these are very, very important, like nature of assurance, internal controls, risk management is there. But once you do certain internal audit, risk management is become a part of that whole practice. Then how to manage the internal audit function, conducting overall internal audit planning, objectives. Now, see, as a for 240 is using the work of an expert, planning the internal audit assignment, internal audit evidence, documentation, supervision, things like that. See, SIA 11 is there, consideration of fraud in internal audit, which we have just discussed so far. SIA 11. So like this, you can find these standards on ICAI website, and these are some of the important standards that we should consider. I hope participants have taken a picture or something like that.
Yeah. So participants are again and again have the same. All the PPTs will be shared with you, everyone.
Yes.
So be assured of that. Okay. So any more questions, participants? I think this is the last one. We don't have any questions. Actually, your session was too good.
I'm glad. That it was.
So now I have been given the task of giving a formal vote of thanks to you. So I'll actually, you have thoroughly explained to all the participants all the procedures and all the steps we should follow to have a effective internal control, effective internal audit of the manufacturing unit. It was our pleasure to hear from you on behalf of ICAI and behalf of all the participants. I would give a heartily vote of thanks to you, and also a round of applause for you. Thank you. Thank you so much.
Thank you. It was
Thank
my pleasure.
Everyone.
It was my pleasure to interact with everyone.
Yeah.
I hope my work.
We were having around 450 participants. So
that's really nice.
Yeah.
That's really nice.
Yeah. Thank you, everyone.
Thank you so much.
Thank you, participants. Without you, of course.
Thank you, Kirti.
Yeah. Thank you so much, sir. Without participants. Thank you, sir.